Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines. We've got a wild week unfolding in the markets, folks. Trump's surprise win has thrown everyone for a loop, and companies are scrambling to figure out their next move.
It's been a roller coaster ride, that's for sure.
Today we're going deep on two stories that really capture the current mood.
Okay, sounds good.
First, we're digging into an accounting mystery at Macy's
Oh boy.
that has investors holding their breath. Then we'll shift gears to the Permian Basin, where AI is quietly revolutionizing oil drilling
Really?
and potentially reshaping the global energy landscape as we know it.
Fascinating. It's a fascinating juxtaposition, wouldn't you say?
Exactly. It's like we're witnessing two different eras colliding.
Yeah.
So let's start with Macy's. This story, as reported in Barron's, is pretty shocking. Apparently, an employee managed to hide somewhere between $132 and $154 million
Wow.
in delivery expenses over 3 years.
You're kidding.
That's not just a rounding error, folks.
No.
It raises some serious questions about Macy's internal controls and what went wrong here.
Absolutely. The article in Barron's points out that this employee was dealing with small package delivery expense accounting. To understand the potential scope of this, we need to think about how these expenses are usually tracked.
Okay.
Companies typically use accrual accounting, which means they record expenses when they're incurred, not necessarily when the cash goes out.
Right.
This employee could have manipulated those accrual entries, making it harder to detect the discrepancy in real time.
And of course, the question of materiality comes into play.
Yeah.
For a company the size of Macy's, even millions of dollars, might not be considered material enough
Right.
to raise immediate red flags in their financial statements.
Yeah.
But the fact that this went on for 3 years is definitely alarming.
It certainly raises concerns about the effectiveness of their auditing procedures. Were there any red flags that were missed? Could KPMG, their longtime auditor, have caught this sooner? These are the questions investors will be asking. And ultimately, this situation could have a ripple effect on investor confidence, even if the financial impact turns out to be relatively small.
It's not just about the numbers, is it?
No.
It's about the potential erosion of trust,
Mm-hmm.
and that's hard to quantify.
Absolutely.
They're adding another layer to this story is Macy's decision to delay their Q4 earnings release to investigate further, as reported in Barron's. What signal does this send to investors, do you think?
Delaying the earnings release is a double-edged sword. On one hand, it shows they're taking the issue seriously and committed to transparency. On the other hand, it prolongs the uncertainty and keeps investors in the dark. It also raises the possibility of further negative revelations, which could exacerbate the situation.
Right. It's a bit of a wait-and-see game now.
Yeah.
And this accounting issue is unfolding against a backdrop of Macy's already challenging retail environment. They did release preliminary Q3 results, with sales down slightly, but luxury brands like Bloomingdale's and Bluemercury actually saw positive comparable store sales.
Oh, interesting.
So the question becomes, how much does this accounting issue overshadow what otherwise might be considered decent performance in a tough market?
It's a tough call, and it will likely depend on the outcome of the investigation. If they can demonstrate that this was an isolated incident and implement stronger controls to prevent it from happening again, they might be able to regain investor confidence. However, if the investigation reveals systemic issues or a lack of oversight at higher levels, the damage could be more significant.
Okay, so we've got this unfolding drama at Macy's, a company trying to navigate a rapidly changing retail landscape while dealing with this accounting scandal. It's a reminder that even established giants can be vulnerable.
Definitely.
But let's shift gears now and talk about a completely different kind of disruption happening in a seemingly old-school industry. Barron's had a fascinating article about how AI is transforming oil drilling in the Permian Basin.
It's a remarkable example of how technology is blurring the lines between industries we once considered completely separate. The Permian Basin, once a symbol of traditional energy production, is now a hotbed of digital innovation with data centers and algorithms working alongside those iconic oil rigs.
And this isn't just about replacing humans with robots, right? It's about using data and AI to make smarter decisions at every stage of the drilling process.
Precisely. Sensors embedded throughout the wells collect massive amounts of data on pressure heat and even the composition of rock formations. AI algorithms then analyze this data in real time to identify the most promising drilling locations and optimize the extraction process. We're talking about increasing efficiency and maximizing output from existing wells.
It's almost like having X-ray vision for the Earth's crust. And the results, as Barron's points out, are pretty astounding. Over the past decade, U.S. oil producers have managed to increase their daily output by a whopping 60%, while reducing their workforce by 40%.
Yeah.
That's a level of productivity gain that outpaces even what we've seen in online retail.
Those numbers are a testament to the power of AI to optimize complex processes. It's not just about doing more with less manpower. It's about making data-driven decisions that lead to better outcomes.
And the financial implications are significant. Barron's highlighted how break-even prices for Permian oil producers have plummeted, boosting profitability for companies like Chevron and ExxonMobil. It's no wonder they're investing heavily in this technology.
It's a win-win for them. Lower production costs make them less susceptible to price fluctuations in the global oil market. And this smart drilling revolution, as Barron's calls it, has already had a significant impact on the global energy landscape. U.S. oil production has skyrocketed, turning the country into a net exporter, which has major implications for energy independence and geopolitical dynamics.
Okay, so we've gone from an accounting mystery at a department store to AI-powered oil rigs in Texas. What ties these two stories together for you? What's the common thread?
I think both stories highlight the transformative power of information, or rather the lack thereof. In Macy's case, it's the lack of transparency and control over financial data that led to this potential crisis. In the Permian Basin, it's the abundance of data coupled with the ability to analyze it effectively that's driving this revolution.
That's a great point. It's not just about the data itself, but about how we collect, analyze, and ultimately use it to make informed decisions.
Exactly. And it begs the question, what other industries are ripe for disruption by data and AI? What are the potential benefits and what are the risks we need to be aware of?
Those are questions we'll continue to explore as we delve deeper into the financial headlines this week. Now, before we move on to Bitcoin's roller coaster ride and the impact of Trump's policies, let's take a quick pause for our sponsors. We'll be right back with more in-depth analysis.
Welcome back. Now let's talk about something that's been anything but stable Bitcoin.
Oh, yeah.
It's been on a wild ride lately,
It has.
especially since the election.
Oh, absolutely. It felt like every time I refreshed my browser, Bitcoin was hitting a new all-time high.
It's been a fascinating spectacle to observe, and it's no coincidence that this surge coincided with Trump's surprise victory.
Yeah.
As Bloomberg reported, Trump has been making some pretty bold promises about making the U.S. the global hub for crypto.
Right.
He's talked about fostering supportive regulations and even creating a national Bitcoin stockpile.
That's right. And Bloomberg also highlighted how Trump's stance on crypto seemed to shift after receiving significant support from digital asset firms during his campaign. It really underscores how money and politics are often intertwined.
It's a reminder that we need to be critical consumers of information and consider the motivations behind policy decisions. But back to Bitcoin's wild ride, it made a pretty impressive run at $100,000, didn't it?
It did.
Didn't quite reach that milestone, but according to CNBC, it did manage to shed a whopping $180 billion in market cap in just one day.
Talk about volatility.
It was a dramatic 24 hours, for sure.
And Barron's had a great piece that really dug into what might happen next. They spoke to several analysts who believed that even after that pullback, Bitcoin could still have room to run. Some even predicted it could hit $180,000
Wow.
or even $200,000 by the end of the year.
Those are some bold predictions. And it's important to remember that the crypto market is incredibly volatile.
For sure.
It's still largely unregulated, and there are many unknowns. But what I find fascinating about this whole phenomenon is how mainstream Bitcoin has become.
You're absolutely right. CNBC even pointed out that there's been this huge influx of new investors piling into spot Bitcoin ETFs.
Yeah.
The iShares Bitcoin Trust, for example, has more than doubled since it launched earlier this year. It's remarkable to think that anyone can now invest in Bitcoin through their regular brokerage account.
It's a clear sign of how quickly this asset class is evolving and becoming more accessible to the average investor. But as with any investment, it's crucial to proceed with caution and do your due diligence. Speaking of due diligence, Barron's also had an interesting article about Rumble, the video platform popular among conservatives.
Yeah.
They announced they're planning to buy up to $20 million in Bitcoin as part of their new treasury strategy.
Yes, I saw that too. It seems like every week another company is jumping on the Bitcoin bandwagon. They even mentioned how Rumble's CEO Chris Pavlovski sees Bitcoin as an inflation hedge because, unlike government-issued currencies, it's not subject to endless money printing.
That's the argument many Bitcoin proponents make, but it's worth noting that Bitcoin's value can fluctuate wildly.
Right.
It's not a guaranteed hedge against anything. But Rumble's move is interesting because they're essentially following in the footsteps of MicroStrategy, which has been aggressively buying Bitcoin since 2020.
And that strategy has paid off handsomely for MicroStrategy. Their stock has soared more than 500% this year. It's almost become a proxy for Bitcoin itself.
It's certainly a development worth watching, especially with Trump back in the White House. He seems to be a big supporter of Bitcoin, and his policies could have a significant impact on the crypto landscape. But Trump's policies could impact more than just the crypto world. Remember back in 2018 when he imposed tariffs on steel and aluminum imports from Canada?
Oh, yes, that was a major event. It sparked a trade war with Canada, retaliating with tariffs of their own. And now, according to MarketWatch, Trump is threatening to do it again. He's talking about slapping a 25% tariff on all products coming into the U.S. from Mexico and Canada, and an additional 10% tariff on goods from China.
It's a bold move, and it's already causing some anxiety in the markets. The Canadian dollar weakened sharply after Trump made that announcement.
Oh, wow.
But MarketWatch also pointed out that Trump might just be using these tariffs as a negotiating tactic.
It's hard to say what his true intentions are. I guess we'll have to wait and see how this all plays out. But one thing is for sure, Trump's return to the White House is going to make things very interesting, to say the least.
Interesting might be an understatement, but it's important to remember that amidst all the political drama and market swings, there are still companies out there focusing on innovation and delivering real value to their customers. Take Zoom, for example.
Yeah, what about Zoom? They released their Q3 earnings, and CNBC reported that they surpassed expectations. Despite all the talk of Zoom fatigue and competition from other platforms, it seems like they're still finding ways to grow their business.
They are indeed. Their revenue grew about 4% year-over-year, which might not sound like much, but it's pretty impressive considering how much they grew during the pandemic when demand for their services was at an all-time high. And they're also branching out beyond video conferencing. They've been investing heavily in AI and developing new features to make their platform more versatile and appealing to a wider range of users.
It's like they're trying to reinvent themselves for the post-pandemic world,
Yeah.
and it seems to be working. They're even changing their corporate name from Zoom Video Communications to simply Zoom Communications. CNBC highlighted how this reflects their evolution into a broader AI-first work platform.
It's a smart move. They're recognizing that the future of work is going to be hybrid with a blend of in-person and virtual interactions, and they're positioning themselves to be a key player in that space.
Before we move on, I want to touch on one more thing that caught my eye. MarketWatch had an article about how small-cap stocks are on the verge of ending a 3-year period of underperformance.
That's right. The Russell 2000 index, which tracks small-cap stocks, has been on a tear this month, up over 11%.
Wow. And MarketWatch pointed out that this rally is being driven in part by expectations that Trump's policies will be pro-growth, especially with his focus on tax cuts.
It's a classic case of investors betting on the future. Small-cap stocks are often seen as more sensitive to economic conditions. So if investors believe that Trump's policies will lead to stronger growth, they're more likely to pile into small-cap stocks, hoping to capitalize on that growth.
It's a risky bet, but it could pay off big time if those growth expectations materialize.
Time will tell. But what I find fascinating is how this whole situation highlights the interconnectedness of politics, the economy, and the markets. Everything seems to be in flux right now, which creates both opportunities and uncertainty.
Speaking of uncertainty, let's talk about it. Tesla Barron's had this really interesting article about how California is considering bringing back electric vehicle purchase tax credits if Trump kills the federal ones. It's almost like a state versus federal showdown in the EV market.
It certainly is, and it adds another layer of complexity to the already dynamic landscape of the auto industry.
It's definitely a head-scratcher. Tesla's stock actually dropped when the news broke, even though California's move would seemingly be a good thing for EV adoption.
It seems counterintuitive, but there's a reason for that market reaction. Wall Street believes that Tesla, with its global scale and cost-efficient production, can thrive even without those federal tax credits. In fact, some analysts believe Tesla might actually benefit from the elimination of federal credits because it would put more pressure on their competitors who might not be as well positioned to absorb that loss of incentive.
So it's almost like a survival of the fittest scenario.
Precisely. But here's where it gets even more interesting. Barron's pointed out that California Governor Gavin Newsom might exclude Tesla from qualifying for those state-level tax credits.
Wait, what? Why would he do that?
Well, it's all about promoting innovation and competition, as they say. Tesla already dominates the EV market in the U.S., so limiting their access to incentives could help level the playing field and encourage other automakers to step up their EV game.
It seems a bit unfair to penalize Tesla for being the frontrunner, though Elon Musk even called it insane on Twitter.
It's definitely a controversial move, and it could have some unintended consequences. For example, Tesla generates significant revenue from selling ZEV, zero-emission vehicle, credits to other automakers. If California's policies make it harder for Tesla to sell those credits, it could impact their bottom line.
It's a complex situation with a lot of moving parts and potential ramifications. It's going to be interesting to see how this all plays out, especially with Trump and Musk's seemingly close relationship. Barron's even called it a soap opera moment.
Indeed. And speaking of soap operas, did you catch the latest on Intel?
Oh, yeah.
Bloomberg reported that they finally secured a $7.9 billion grant from the Biden administration as part of the C-CHIP PS Act.
Oh, yes. That's a big win for Intel. They've been facing some challenges lately, but this funding should give them a much-needed boost as they try to ramp up their chip manufacturing in the U.S.
It's a significant investment, but it comes with strings attached. Barron's pointed out that Intel agreed not to conduct stock buybacks for 5 years as part of the deal.
So they're essentially being told to invest that money back into their business, not into inflating their stock price.
Exactly. And it makes sense given the strategic importance of semiconductors and the U.S. government's goal of boosting domestic chip production. This move is about strengthening the U.S. position in the global technology race.
It's a reminder that we're living in a world where technology and geopolitics are increasingly intertwined.
Couldn't have said it better myself.
Oh,
Look, brings us to the end of another deep dive. It's been quite a week, hasn't it? From accounting mysteries and AI revolutions to Bitcoin's wild swings and political dramas, the financial landscape is anything but boring.
You can say that again? It seems like every day brings a new set of challenges and opportunities. But that's what makes it so exciting to follow, right?
Absolutely. It's a constant reminder that we need to stay informed, adaptable, and ready to embrace the unexpected.
And most importantly, we need to keep asking questions and challenging assumptions. Who knows what surprises tomorrow's headlines will bring?
That's the beauty of it all. The future is unwritten, and we're all along for the ride.
Well said. Thanks for joining us on this deep dive into the world of finance and technology. We'll see you all tomorrow morning with new headlines from major financial magazines.